Hi everyone, welcome to the Real Estate Tax Tips channel. My name is Cherry Chen, a chartered professional accountant located in Toronto, Ontario, Canada. And I'm on a mission to become the Google map for hardworking Canadians seeking financial freedom. Are you a real estate investor who are trying to raise funds to help you advance and to grow your portfolio to the next level? Are you just a regular daily folks that are trying to partner up with your friends or families to invest in real estate together? If so, this is the perfect video for you because we are going to dive deep into the three common structures that you would use to invest in real estate with an investment partner. But before I get started, make sure you give us a thumbs up if you find that video useful, or you hit the subscribe button to stay on top of the latest tax tips. Many of my clients invest with investment partners these days. They are either the passive money partners who provide capital to fund the investment projects. So they're usually more passive, staying on the back and earning a fixed rate of return, or earning a smaller percentage of the equity appreciation. Some of my clients take on the active real estate expert route, and they're the one that's responsible for sourcing the deal, managing the day-to-day business, and also improving the property at the same time. So they need to actively look for investors who have money to help them to pay for the initial down payment as well as the cost of renovation. So these investors would need to form some sort of a business model with their investment business partners. There are three common business models an investor can follow when it comes down to investing with an investment partner. Here are the top three. The first one is a joint venture investment. The second one is via a corporation. And the third one is limited partnership investment. And we'll get into detail in terms of the benefit, pros and cons and details of the structure in each and every one of them. First form of business model is called joint venture. According to Thomson Reuters Practical Law's website, joint venture has no legal meaning in Canada. It represents a business model that multiple parties pull together their resources and share expertise for the common purpose of a business venture. In real estate investment world, in plain English, joint ventures are often formed by multiple parties with the objective of investing in a particular investment properties. And flexibility of the structuring is one of the benefits of using joint venture as your business model. From a tax perspective, joint venture provides a lot of tax benefit. It allows the participating investors to select the type of ownership that they prefer. Like, for example, two real estate investors are interested to invest in legal duplex in Hamilton. They pool their capital together. Everything is 50-50. One of the investment partner is a doctor who is extremely busy with her day-to-day schedule. She made all her money within her professional corporation. And based on the accountant's advice, I often advise my client because they're source of fund is from the corporation, she would be able to use her corporate fund from her doctor's professional practice to invest in a corporate structure in this particular joint venture partnership. The active real estate investor expert in this example that we're talking about just recently quit his job. Given his circumstances, his accountant advised him to invest in his personal name because he's not concerned about legal protection liability and he has very little income to invest. On the flip side, the doctor has a corporation and made her money through her corporate earning. And her corporation can be used to form a joint venture with his personal name to invest in the legal duplex in Hamilton. So in other words, a joint venture can be formed by a corporation and a person together to invest in properties. And a joint venture can be formed by two people together. It could be you and me forming the joint venture to invest in the property together. It could be two corporations forming the joint venture together to invest in the properties. And it could be more than two parties as well. It could be as many parties as you want. The possibility is endless. Joint venture also has this flow-through nature. Each joint venture partner is responsible for reporting his or her share of income, expenses, assets, and liabilities of the joint venture. So let's use an example to explain. If I invest in a joint venture together with my husband, Erwin, and we each own the investment property 50% as a joint venture. We invest using the joint venture structure. I would be responsible to report 50% of all the income and expenses and assets and liabilities on my personal tax return. Now, however, if I'm using my corporation to invest to form this joint venture with him, my corporation would also be responsible to report the income and expenses, 50% of income and expenses, assets and liabilities of this particular property. So everything that's related to my share, I would report on. If you invest in the joint venture using a corporation, this may include reporting your proportional assets and liabilities and shares and expenses on the corporation. If you have multiple joint venture investment, then the reporting of these joint ventures can be very complicated and record keeping can be very challenging. We have a lot of active investors out there that do a lot of joint venture deals, and it often poses a lot of challenges when it comes down to year-end filing reconciliation, because you own property A for 50%, own property B for 30%, own property C with the third partner for 20%, and we have to go back and recognize only 20% of one property, 30% of another, 50% of another. And if you want us to also reconcile the balances of each particular property, it gets even more complicated. So joint venture within a corporation, joint venture investment within a corporation could be quite expensive when it comes down to maintaining your books. One of the biggest benefits of joint venture business model is that each joint venture is allowed to deduct depreciation on their own, at their own will. Deducting depreciation is also known as the capital cost allowance based on his or her own situation. So let's use my example that I'm investing with Erwin. I own my own real estate portfolio in my own personal name. I have different portfolio from my husband. I may have 5 properties that I am reporting net rental income on. And then with this particular investment property that I just formed a joint venture with my husband, it's not making money yet because it's a brand new property. And chances are, as you all know, brand new property don't usually make money in the first couple of years. So if you look at that joint venture as a whole, technically speaking, the investors are not allowed to claim capital cost allowance because the property on its own is already reporting a loss. However, the joint venture, if you invest through a joint venture way with your partner, each investor would get their proportional share of assets. The income tax act would look at the portfolio as a whole. I already make money from my 5 pre-existing properties, net rental income, plus the loss of this new 50% of the loss that's incurred on this new property that I co-own with Erwin. Any net rental income that I report, I could potentially use the capital cost allowance that I can potentially claim against this new property to offset the net rental income. So it makes a difference if you have other properties available for you to claim the capital cost allowance of this new property. If Erwin and I were to invest in the form of corporation or in a limited partnership setting, capital cost allowance is restricted at the corporation level or partnership level. It's not at the individual level. So I don't have the flexibility if I were to choose to invest in the corporation format with him rather than the joint venture format. Now, next thing that we need to talk about, joint venture agreement. I mean, whenever you form any type of relationship, you always should have sign something called a joint venture agreement. I can't stress how important it is to have a proper joint venture agreement drafted and signed. The joint venture agreement generally specifies the roles and responsibilities of each investment partners, and it does not have to be like heavy legal lingo. I know some of the joint venture agreement, it could be like quite difficult and quite challenging to read and understand. Trust me, I've read a lot of them and it's hard to understand, but there are a lot of them that are quite user-friendly, and you and I would both be able to read it. I mean, English is not my first language. If I can read it, you would be able to read it. Find a partner, investment-friendly partner, real estate joint venture specialist, real estate lawyer, to help you draft this joint venture agreement up with your investment partner. It should also include the responsibilities and roles of each investment partner. It should stay how you divide up the day-to-day profit, funds from refinancing, and at sale. And it should talk about the investment horizon of your joint venture relationship and how you're going to resolve conflict. It should talk about what would happen if one partner passes away to protect the estate. So make sure you speak to that specialist real estate lawyer to draft up the proper joint venture agreement. Just because you are investing with a friend, or just because you're investing like me, investing with my husband, does not mean that there are no issues down the road. So make sure that you always sign that joint venture agreement, even with your spouse. Not necessarily to protect your right, but it could help when it comes down to CRA audit as well, especially when the title is not the same as the ownership percentage. Now, the second way to structure your investment relationship is invest via a corporation. Now, corporation is another commonly used structure that investors use to invest together. Each investors would contribute their capital or lack of capital, contribute their expertise into the venture together. Each investor would be issued shares based on what they are responsible for. Some investor would contribute capital, and while some other investor would contribute their time as well as their expertise. The biggest benefit of investing with your partners via corporation is the legal liability protection feature of the corporation. Now, corporation is considered a separate legal entity. It can sue other people and other corporations, and it can be sued by others on its own. So generally speaking, you can have legal liability protection against your personal asset if, in the unfortunate event, that your corporation is sued by a patron or a tenant. Then your corporation is being sued. It has nothing to do with your other assets that you own in your personal name. Now, this is the major difference between joint venture business model versus corporation. If you were to invest using a joint venture model, JV model that I mentioned earlier on, the exposure to liability also got flow through to the joint venture investment partners. So if my property gets sued, the reality is that I and Erwin would be the ultimate person being sued as well. So anything that's related to what we own would also be exposed to the lawsuit. You might be exposing either all of your personal asset or corporate asset when you invest through joint venture structure to that particular joint venture investment property. Second benefit of having a corporation over joint venture is the ease of record keeping. Remember earlier on, I mentioned that when you invest in joint venture, you are responsible to report the income and expenses, assets and liabilities of the particular investment property that you're investing in. And it could be quite cumbersome because when you invest it in a corporation, in multiple joint venture, it is a consolidation of multiple sets of income and expenses, and it can get really complicated. But when you invest within a corporation, the benefit of investing through that corporate structure is the ease of record keeping. Since the property is typically 100% owned by the corporation, 100% of the income and expenses, assets and liabilities are reported within the same entity, avoiding any complex proportional interest consolidation. But the losses and depreciation are capped at the corporation level, unfortunately. What I meant by that is that there is no flow-through feature, unlike joint venture structure. From my experience, and I'm sure a lot of you could relate to this, most long-term rental real estate venture, or even when you do short-term rental real estate venture, does not generate much profit at the very beginning, not for the first year, likely not second year as well. And often we see losses in the first couple of years or number of years during stabilization. And for those people who are working in even bigger multi-family unit projects, they need years to stabilize the entire project. So losses incurred from the operation of the real estate rental or your projects, whatever it may be, are staying at that corporation level. It cannot be passed through, it cannot be flowed through to my personal tax return or my corporation tax return to offset against the other income that I am earning. So that sucks because it's remaining at the corporation level. Now, similarly, the depreciation, also known as the capital cost allowance, CCA for short, is claimed at the corporation level. So if you are having this property that you are incurring significant losses at the very beginning for the first couple of years, you're not eligible to claim the capital cost allowance. And because the property is owned directly inside the corporation, 100% by this corporation, you're not even eligible to claim capital cost allowance at all, let alone being passed through to your corporation's name, your individual corporation's name and personal name to offset against that income, other income that you may receive. Had you set up a joint venture, you would have been able to utilize your proportional share of losses incurred during the stabilization period, as well as the capital cost allowance to offset against the income from other properties. Now, with corporation, instead of signing a joint venture agreement, you would sign something called a shareholder agreement. It's quite similar, it's just different type of agreement. With corporation, a detailed shareholder agreement should be signed. Each shareholder should seek independent legal advice from their respective lawyer, understanding what it entails, the shareholder agreement entails. Similar to joint venture agreement, a shareholder agreement should always detail the roles and responsibilities of each partner and the expectation of each investment party. Some may be more passive than the others. Some may expect a passive return. Some may even expect the return of their capital at the very beginning. An experienced lawyer would be able to help you draft out a proper shareholder agreement that everyone is comfortable with. And as mentioned earlier, a shareholder agreement should also have information on the expected investment horizon, steps on how to resolve conflicts, and what to do when one of the investment partners decide to sell his or her investment interest later on, before the term that it was agreed upon. Okay, the third form of investing with an investment partner is something called a limited partnership. In recent years, it's gained quite a bit of popularity among my real estate investment clients. Limited partnership, in a nutshell, is a form of general partnership. It's just really a few parties coming together to form a business, and in this particular case, to buy an investment property. Now, it could be more than two partners. Typically, it is operated with a single general partner with unlimited liability. So the limited partnership, the idea of the limited partnership is to provide limited liability to most partners, with one general partner absorbing all the liability. Now, in exchange for taking all the risks, obviously, the general partner is often rewarded with higher share of income and gain. And the limited partners contribute to the capital, but they are typically not involved in the day-to-day management of the business in order to stay within that limited partnership definition, and also not being dinged on being included as part of the general partner, being exposed to the unlimited partner, unlimited risk nature. Now, the liability of these limited partners is restricted to the amount that they invested. As you can see, this is quite complex structure. Minimal cost to set up these type of limited partnership is at least $10,000 and up. And it also goes up depending on the complexity of your limited partnership. But there is a reason why people use this type of structure. Now, the people who like using limited partnership to invest typically invest with in a bigger scale. And from a tax perspective, a limited partnership is required to file its own partnership return. And as mentioned before, capital cost allowance, commonly known as depreciation, is also claimed at the partnership level. So what it means is that if the property invested is not generating any net income, the partnership is not allowed to take any capital cost allowance to defer the net rental income for income tax deferral purpose. So similar to the corporation, the capital cost allowance are capped and claimed at the partnership level. In the corporation situation, is claimed at the corporation level. The individual limited partner has no say in terms of whether they are claiming capital cost allowance or not. And if it is not claimed, it is not claimed. If the partnership, the underlying asset, underlying rental property is not generating any cash flow, in Canada, you're not allowed to claim any capital cost allowance to create a bigger loss. So even if the individual limited partner that invests capital into the limited partnership has other sources of rental income, he or she would not be able to use the capital cost allowance that would be otherwise available from this limited partnership underlying property to offset against the other source of rental income received. So that's the part that's not going for limited partnership. But if the underlying property is generating net income, the partnership is only allowed to take the capital cost allowance to reduce the net rental income from that particular property to zero. Unlike a joint venture relationship though, each individual investment partner does not have the freedom to claim more than what was determined at the partnership level in terms of capital cost allowance. Now, similar to joint venture business model, if the underlying property is generating at a loss, in the initial years of operations, the losses can be flowed through to each individual limited partner. So my corporation could be one of the investing limited partner in this limited partnership. If there are losses being incurred in the first year, I could report that proportional amount of losses that I own and I was allocated to in my corporation's tax return and use that loss to offset against income, my other corporation income. And each investment partner can report its shares of losses offsetting against other income he or she may receive from other sources. For investors who are investing as limited partners, the amount of losses that they can claim, as much as you want to claim losses, but they can only claim up to the amount called at-risk amount, which is generally defined as the amount of capital that you've invested plus the income allocated over the years. So you can only claim losses up to the at-risk amount. For limited partners, investor, you may have a deemed capital gain if your adjusted cost base of your investment is negative. And for real estate limited partnership investments, this situation can arise when you refinance the underlying property multiple times. Essentially, you use the BRRRR strategies multiple times and refinance and extract almost all the initial capital that you've invested in the property to your name. And you have the refinance money have repay your initial capital investment. This could trigger a negative ACB, and therefore you would have to report capital gain on your tax return and pay tax on it. Now, the calculation of the at-risk amount as well as negative ACB, negative adjusted cost base that we mentioned, can be quite complicated, and thus the filing cost can be more expensive than a regular corporation. Now, legal liability protection. We mentioned before the way that we form the limited partnership is we have a single general partner that absorb unlimited amount of risk, and we have the limited partners who contribute capital, but they are not involved in the day-to-day business. So the biggest advantage with a limited partnership over a joint venture is that it allows for limited liability protection and the flow-through nature of the income and expenses. So the general partner will be responsible for the day-to-day operation, the management of the business, as well as absorbing all the risks involved in operating this property. Typically, the real estate investor would set up a corporation to act as a general partner though. So then the corporation again is providing the extra layer of protection to the individual general partner. Similar to all other forms of investment, you should always sign an agreement. And in the limited partnership situation, it's called limited partnership agreement. As always, as an investor of a limited partnership, you should read the agreement in detail, read all the fine print to understand your rights and have your rights protected. As a general partner, having a limited partnership agreement to set out all the rules and conflict resolution can prevent a lot of problems down the road. Now that I have covered all three common structures that you can use to invest with a partner, what are the ones that you are currently using? If you're using any of that, let me know in the comment section below. If you find this video useful, make sure you give us a thumbs up and share it with your friends who are considering going into different form of investment journey with a partner. If you have questions, make sure that you provide feedback below and we will get our team to contact you as well. And if you are currently working on just a handshake deal, make sure you don't do that anymore and you need help. If you are working on handshake deal, talk to us. And we will provide you the best structure based on your particular circumstance. Until next time, happy Canadian real estate investing.